Hello, CANSLIMers. This is Ken Simpson. I am a member of several of the Northern California IBD meetup groups, and I wanted to provide this short presentation on the basic cell rules. People seem to have a difficult time learning the cell rules. They seem convoluted, though they're not. They say a picture's worth 1,000 words, so I thought I'd do a visual presentation of the cell rules. Hopefully after seeing this, when you read the cell rules in the source material, the books, maybe the cell rules from your IBD meetup, they'll make a little more sense. It's a learning tool. Of course, a little housekeeping. CANSLIM is a registered trademark of Investors Business Daily. The charts in this presentation were created using MarketSmith, and I have pattern recognition enabled, which you'll see in a second. And the standard disclaimer, I'm not an investment advisor, and this is not investment advice. It's educational purposes only. Nothing in this presentation is a recommendation to buy or sell any security. You're on your own. This is a learning tool. Hopefully you become a better investor because of this, but I'm not responsible for your gains or losses. Now, the cell rules that you're about to see were adopted from How to Make Money in Stocks, the book by William O'Neill, the founder of Investors Business Daily. These rules have been codified by Lee Tanner, leader of the Petaluma IBD Meetup group. If you haven't been to the IBD Meetup in Petaluma, I encourage you to go. It's a fantastic wealth of information, and if you can visit their website, you can study the cell rules in more detail. Every trader has a unique personality, so please modify these cell rules to suit your own needs, your risk for tolerance, etc. So let's get started. Here's a stock you've been following. It's on your watch list. You want to own it. You're looking for an entry point. This is a beautiful stock. It has a greater than 100% run-up. Put in a base. In fact, it looks like it's putting in a cup with handle. If you look to the right side of the base, you see you're 4 days into a handle. If it looks like tomorrow, if the stock performs as it has in the past couple of weeks, you're probably going to put in a handle here. So the next day happens, sure enough, it puts in a handle. You're 5 days now, which is what you require for a handle here on the daily chart. The MarketSmith even tells you, it gives you, if you have pattern recognition, it gives you the green cup with handle indicator there. It also gives you the entry and exit points, the green, blue, and pink boxes that you'll see. It tells you the pivot point. That's the ideal buy point, which is the high of that handle on the right side plus 10 cents. It tells you that it gives you the buy zone. The buy zone is from the pivot point up to 5% above. Now this is important. You can't be chasing these stocks. You try to get them as close to the pivot point as you can, and you don't want to be buying them above the 5%. And you're going to see why here in a second. But you want to try to get it as low in that blue box as possible. In fact, there are some people have early entries to try to even get in better than the pivot point. So here's the next day. Starts to move up. Next day. Starts to move up. Now, an advanced trader could say, hey, you know, I can put in a sloping trend line here. It's an advanced strategy for an early entry. This is a bona fide sloping trend line across the highs of the handle, and the trend line itself is less than 45 degrees. So this could be a possible early entry for an advanced trader, and we're going to show you why here in a second, what happens if you got into the stock a little early. So here comes the next day. Well, if you had that sloping trend line in there, you just bought this stock. This past your sloping trend line, it's a stock you want to own, performing nicely. You should have purchased this stock today. Now you might have a little small loss for the day, but if you're an advanced trader using that early entry, you're in this stock. If not, you're casually waiting for the piercing of that pivot point to break into that blue zone. Next day happens, down a bit. If you're in the early entry, you're down a few bucks. Don't panic. It's not very far. Again, kind of a boring day. You haven't really done anything. The stock has not yet broken out. But if you did the sloping trend line, you could be in this stock. If not, you're waiting for the breakout. Sure enough, the breakout comes the next day, and this is a bona fide breakout. Blows through the pivot point. You had chances all day to buy it at or below the pivot point. You probably could have bought this at exactly the pivot point if you had a stop order in, a limit order. So now this gives you, IBD gives you the volume signature here. This is a bona fide breakout. Proper volume signature. The RS line confirms the breakout. If you're a CANSLIM practitioner and you want this stock, you're in it. You own this stock. So now what do? We've covered the purchase. This presentation is about the sell rules. Anybody can buy a stock, but selling them properly is just as important, if not more important. So here we go. We're going to show you what happens over the next few weeks when you're in this stock. You just purchased it. Okay, sell rule number 1. Always sell any stock that goes down 7 to 8% from the buy point. And you'll notice that I've highlighted that buy point. Most of the targets that you're going to see in the rules are based on the pattern. This particular rule is not based on the pattern. It's based on your buy point. Market Smith doesn't know what you paid for the stock. The stock doesn't know what you paid for it. You have to exercise this rule based on your buy point. And this can't be emphasized enough for reasons you're about to see. Why do we do this from the buy point and not from the handle or from the breakout or something else? Why is it based on what I paid for it? That doesn't make sense. Well, this is a mathematics-based portfolio insurance. It's based on the principle of nonlinear compounding of gains or losses. What? Okay. When you have a X% gain and you have a future X% loss, you're not back to even. Your losses compound more strongly than your gains, and that's important to know. If you have a 7% loss, you have to have a future 7.5% gain to get back to even. If you have an 8% loss, you have to have an 8.7% gain to be back to even. Now those are manageable. You know, there's a 7+% change just on this breakout day. So you can certainly survive a 7% loss on a single position. All you've got to do is recapture that by a 7.5% gain on the future. It's highly manageable, and you have to take those losses. As we continue, if you have a 10% loss, you have to have 11.1% gain just to get back to even. That's still fairly manageable, but you're starting to get to a point where you really have to stop taking these losses. 11% gains are far less frequent than 7.5% gains. Now, if you have a 50% loss, you have to have 100% gain in the future just to get back to even. 100% gains are few and far between. So that does damage to your portfolio. You have to avoid those 50% losses. Taking a 7% loss, you can survive. 50, that damages your portfolio. And of course, if you have a 100% loss in a position, that can never be recaptured. That money's gone. You can't invest it in another stock to try to recapture it. So think of this as insurance. This rule has nothing to do with the chart pattern. It's solely it is solely to help protect your account from a major drawdown. Your 7% losses are insurance premiums against an irrecoverable loss. And think of them that way. It's every time you take a 7% loss, nobody likes to take that 7% loss, but it's an insurance premium against a damaging loss, a major drawdown, which has damaged your portfolio. I just want to emphasize, this is not from the pivot point, it's from the buy point. Now, why do we say that? Now, going forward, let's say on Market Smith gives you this pink zone. That's -5% to -8%. That's your warning. That's where you need to start exiting this position. You can't go beyond that, or you start to do damage to your portfolio. Now, that's based on the pivot point. Market Smith doesn't know what you paid for this stock. The stock doesn't know what you paid for it. So that pink zone is drawn based on an ideal entry right at the pivot point. Okay? Now that's important because you probably didn't get in exactly at the pivot point. So you have to adjust that pink zone. Market Smith doesn't adjust it. It puts it right there every time based on the ideal entry. But your entry is probably a different price. For example, let's say you got in right there on that sloping trend line on early entry. In that case, you'd move your pink zone down. Okay? You're not going to sell it when it gets into the pink zone of Market Smith. You just move that down. Of course, Market Smith doesn't do that, but you have to think of it this way. If you got in up here, let's say you were working, you couldn't get in until late in the day, or perhaps you're waiting to make sure the volume confirmed the breakout. You didn't get in until near the close. In that case, you'd move the pink zone up. So you have to sell that earlier. Now, this is why you don't want to chase these stocks, because you're going to try to have to sell this if it gets down in the pink zone, and that's pretty close now. But the point of this is Market Smith's pink loss indicator is from the pivot point, and it's different from the price you paid more than likely. So you have to not always rely on that. So let's say the stock does this. IBD says 40% of stocks will return to the pivot point after breaking out. If you didn't buy it till up there where the red arrow is, and this returns to the pivot point and then a little bit, you're taking that loss. And a lot of stocks are going to do this. So if you start chasing these stocks, so this one is not really even considered chasing. This is still in the top end of the buy zone, but you're going to take a lot more losses. It's really important that you try to get into these earlier or as close to the pivot point as possible. Just for this reason, sell rule 1, you're going to be exercising a lot if you're chasing these stocks. Why? Well, you're trying to avoid this. You don't think that can happen? Look to the left side of that chart. These stocks can and will drop 50%. You have to get out of them. They will do this to you, and you have to avoid this. That's the whole purpose of sell rule 1, to not do significant damage to your portfolio. Okay, we're going to move on to sell rule number 2. I hope that made sense. Sell rule 2. Sell most stocks that rise 20 to 25% from the pivot point. Now this is from the pivot point. Forget about what you paid. The pattern doesn't know what you paid, doesn't care. The stock doesn't know. The patterns are repeatable patterns that IBD has discovered through their research. They seem to think these patterns repeat. So they say that most stocks should perhaps form a new base when they get to 20 to 25% from the pivot point. So you want to sell them. Okay? That's what the green zone is. That's your 20 to 25% from the pivot point. That's your target. Okay? Now we're going to add sell rule 2A. Most stocks should be held for at least 8 weeks. Okay? So it's not just as simple as selling at 20 to 25%. I'm going to drop this box in here. That is your 8-week line, or 40 trading days, both legitimate. 40 trading days later, you want to try to hold it to at least there. Okay? And why do you do that? Well, many times the stock will come up quickly. This one's 6 weeks. It's up well past the 25% zone. Do you sell it? Well, according to sell rule A, you want to try to give this to at least 8 weeks. And here you are, you're 25%, but you're not 8 weeks, so you don't sell it yet. The idea is you're hoping that you can get up to here. This is a stock performing well, and in this case, you might get even higher. You might get a 30, 35% gain. Okay? So you want to try to give it 8 weeks. This is 25+% and 8 weeks. That's the sell target, according to sell rule 2 with 2A attached. Here you go. You've got to the 8 weeks, but you haven't got to the 25%. What do you do? Okay? Well, you've given it at least 8 weeks, but this stock's performing well. You're hoping that it does something like this. So you're going to wait. You're going to try to give it time to get to the 25%. Okay? You have to be a little patient here. So now you'd sell it out here. This is 11 weeks later, something like that. 8 weeks plus and 25%. So that's where you would sell it. Sell rule 2B. Okay? This is from Petaluma Sell Rules 14 and 19. Give it time. If the stock hasn't hit Sell Rule 2 before 8 weeks and hasn't failed, try to give it 13 weeks to prove itself. Okay, a lot of these stocks aren't going to hit 25% in 8 weeks. They're still good stocks. You still want to be in them. They still have the potential to go higher. But you have to give it some time on some of these. So here is the end. I've drawn this 13 weeks, which is 1 quarter. If you look at MarketSmith, the darker axis lines there, those are 1 calendar quarter. The dotted minor axis lines there, those are 1 week, 5 trading days. But the darker lines, that's about the distance that you want to give these things. That's your 13 weeks. So when you're looking at the MarketSmith chart, look for those dark lines, and that'll give you a good judge of how far you need to get out. Okay? So I've drawn this from 13 weeks to 1 quarter. You want to try to give it that much time. Try to be patient. Even leaders, the best of the stocks, can meander for a few weeks before rocketing higher. You're hoping you get something like this. Okay? Be patient with some of these. They're not all going to go to 25% in 8 weeks. Now, there's some subjectivity to this 13-week rule. Sometimes you're going to get a laggard or a stock that's just moving sideways, and you see a new breakout that you really want to be in. It's okay to sell it before the 13 weeks is up and redeploy your capital. It's your money and your decision. So you have some subjectivity here. It's not hard and fast that you have to hold a stock for 13 weeks, but it's just a guide that, some of these stocks take a little longer, and to be patient. You haven't gotten into trouble with this one yet, maybe give it some time. Okay, recap. Cell rules 1 and 2. Combining the principles in cell rules 1 and 2, we can redraw the target zones in MarketSmith. It would be nice if MarketSmith did this, perhaps in a future version, but for now we're just going to imagine this. Okay? This is what the target zones look like. This is what they should look like in MarketSmith, but they just simplify this. This is what I call the simple cell rule sandbox. You're going to keep your stocks within this sandbox. 25% after 8 weeks is there. 13 weeks of patience, that takes you to there. Of course, your 7% from buy point takes you to there. You want to keep your stocks within the sandbox. If it crosses any of those zones, you're selling them. If it's in between, then you're on your own. Just keep this holding the stock until it gets to one of the sell points. No matter where the stock heads, we have a sell rule here. We've only covered cell rules 1 and 2, but we're already covered everything that can happen short of gap downs and things like that. So here we go, I'm going to show you different examples. If your stock rises well more than 25% and hits the 8-week target, sell it. It's probably going to put in a base, more than likely going to put in a base. Gets to the 25% and the 8 weeks, sell it. Takes longer than 8 weeks, but still gets to 25%, you're selling it. Doesn't really go very far, and you lose patience with it after you're patient for 13 weeks and you're tired of the stock, move into something else, sell it. Moves up, comes back down, you were patient, give it to the 13 weeks, sell it. Fails immediately or somewhere in between, you're out. Anywhere this stock can go, we have sell rules. We've contained this to sandbox. Okay? That's what this cell rules 1 and 2 are for, is to do this. When you read the cell rules, you don't really get this visual. It's hard to imagine what it's doing, but this is what it's doing. It's trying to contain your stock to a sandbox and give you exit points, predetermined. There are many other rules we could add that to handle how it might perform while in the sandbox, but this is a simple set just for those boundaries. But let's go add the cell rule number 3. Cell rule 3, decline from the peak. When a stock has risen 7% from the buy point, move up the sell point to a minus 5% instead of the minus 7 or 8, wherever you're at. Then keep the sell point 11% below new highs until a sell is triggered. Okay, that's a great rule. What does that look like? That certainly changes the sandbox. Well, if the stock breaks out, gets up plus 7%, you're moving your sell point up. Now you're at minus 5%. If the stock performs something like this, which is something that we all hope to see, every time it makes a new high along the way, you're raising your stop. Here, you raise your stop until it's profitable. Okay, as it moves higher, every time it makes a new high, you're 11% from the peak of this pattern. Okay, from these new highs here, 11% from the peak. Every time it makes a peak, you're moving your stop up. Now look what we've done to your sandbox. Come here to the end. This stock's going to be sold here pretty soon. I'm not sure where, but if nothing goes sour like a gap down or something, you're going to make money on this stock. You're going to sell it pretty soon. But this is how you contain these. This is what the sell rules look like. This is what cell rule number 3 does. You have cell rules 1 and 2. Now you have 3. You can see this sandbox. It keeps the boundaries of the stock in, and when it crosses the boundary, you sell it. Okay? So, what happens if a stock just goes to the moon? What do you do? Here's a bonus. Cell rule number 8. Certaintied 8-week hold rule. If a stock advances 20% or more in 3 weeks or less, hold it for a full 8 weeks, then reevaluate. Now, this isn't really a sell rule. This is a don't sell rule. This is a suspension of most of the other sell rules. And I'm not going to go into that in detail here. You can read about it and look for the Certaintied 8-week hold rule in How to Make Money in Stocks or the Petaluma IBD sell rules. Goes over it quite well. But I just wanted to show you what that looks like on here visually. Okay, this is, if it gets up into there, you're going to suspend a lot of the sell rules. You're not going to let this go into a loss, but you're going to get rid of many of the other sell rules. But it just gives you a graphic look at what that sell rule does. Okay, so here we go. This is your simple sell rule sandbox. This is what, if your stock moves according to your hopes, that's what it looks like. When your stock crosses any of those boundaries, you're going to take action. Okay? Many other sell rules. The preceding was just a basic rule set for those just starting out to studying the CANSLIM methodology. I encourage you to study the source materials to learn more. Okay? Read how to make money in stocks. After you've seen this, I think that when you read those sell rules, it's going to make more sense what they're describing. And remember, you're solely responsible for your trading. Educational purposes only. I'm not an investment advisor. Nothing in here is investment advice. And if you have any questions, I'd love to hear from you, but hope you enjoyed the presentation.